in the headline, we're saying debt-fueled buybacks. I mean, and that's a good thing. Surely buybacks are a good thing when stocks are cheap, and they're not particularly cheap, and when it's being funded outside excess earnings, excess revenues, but not from debt. So talk us through why debt-fueled buybacks now is a good thing.
Well, in general, the credit market's on fire. Companies have been able to borrow record amounts of debt this year. That was not the case last year, and most of that money is going into buybacks, including the cash flow that companies are driving. More importantly is how much they can borrow. The credit markets are on fire. In the long run, that's good for stock prices. In the short term, though, it's gotten a little bit overdone, and I think we're due for a pullback.
It's so interesting you say that in the long run it's good. I could perhaps see the opposite argument why in the short term it's good for stocks, because there's a buyer out there. In the long term, if it's funded by debt, surely there's going to be a comeuppance at some point.
Well, there's always a comeuppance. So we had the comeuppance in 2000, 2008, and in 2020. But each time that was from a higher low. So over time, stock prices go up because of the buybacks. But in the short term, buybacks lag stock prices. So last year, stocks went down because buybacks petered out, because the government was borrowing too much money, people felt, from August to October. But in October, I pointed out on this show that the government was done borrowing money. They'd hit their targets, and that sent the buybacks into overdrive. So we've had a move since last October through now from one standard deviation below the trend of stock prices to one standard deviation above the trend of stock prices. That's a huge move in the last 6 months. It's probably overdone. And when you get that type of a move, that's when the buybacks slow down temporarily as corporations husband their cash. They think we've done enough to boost our stock prices, and they don't start the stock prices again or the stock buybacks again until stock prices have gone down or had a correction of about 10%.
It's really interesting, Bob. I mean, Brian, I know, is not saying this explicitly, but one could extrapolate a little bit as if buybacks is the only driver for markets, and if they dry up, then they'll correct. What's your take on that? How important, Bob, are the level of buybacks for overall market levels and sentiment? And do you agree there with Brian's take that we might be a bit stretched to the upside in the short term?
Yes. Here's the problem I have. It's one thing to argue when you're buying back stock with cheap debt like it was a couple of years ago, but that's not so cheap anymore. And I think companies are going to be a little more careful buying back debt when the cost of borrowing is a lot higher. So that's one natural break that I see out there. Other than that, it's interesting to watch the competition. I've been doing this for 25 years. You've been doing this a long time, Wilf, too, between buybacks, dividends, and capital expenditures. There was a time when dividends were a lot more popular. Corporate America's pulled back a little bit because they like the flexibility of buybacks. And it is an interesting way to return cash to shareholders, providing you actually can reduce the share count. And there are some situations where they don't actually do that. Some companies are now doing dividends. Meta just announced a dividend, for example, in addition to a buyback. So there is competition out there. The key story is, what does corporate America do with the cash flow, with the excess cash flow? President Biden wants them to go and suddenly spend more on capital expenditures and hiring people, but that's really a function of the economy. So I don't have a problem with corporate buybacks. I have a problem with doing it when they're having to use debt to do that, and the cost of the debt is a lot higher.